Hi everyone, I am Karan and welcome to Karan's Gyan. Today I'll be talking about one of the most undervalued Navratnas. Navratnas are public sector undertaking companies that have a majority stake that is held by the government. In this case, it is REC. REC stands for Rural Electrification Corporation. It has a really good business with a lot of growth and it has really good quarter one results. So I will be discussing both of them. So before getting to know its quarter one results, let us understand its core business. Like the company's name says, it is called Rural Electrification Corporation. So it has something to do with providing electricity to rural areas. So what this company does is it borrows money at lower interest rate from the public, and it lends out this borrowed money to promote rural electrification. How does it do that? It gives loans to state governments, it gives loans to private entities, and it gives loans to joint ventures of both state and private entities. Now, when it gives out loans at a higher interest rate, and obviously, it eats the difference between both these interest rates. That is the net interest margin. That is their profit. Now, why is this business model good? Well, this business model is good because the area of rural electrification has tremendous growth. As we know, urban areas are much more developed than rural areas, and urban areas have 24-hour electricity, whereas a lot of rural areas do not have even 12 hours electricity a day. So this company wants to develop electricity in rural areas, and since India has more rural population than urban population, this caters to an excellent number of people, and it has an excellent growth, because if rural areas start having electricity, the electricity consumption in rural areas might overtake that of urban areas. So let us have a look at its quarterly results. If I look at the results on quarter basis, where I compare quarter one results of this year to quarter four results of the last financial year, I see the interest income on the loan assets. It has increased by about 3.84%. It has got interest income of 8,000 crore, about 7,986 crores just from interest this quarter. So this shows the magnitude or the size of this company. Like I said, it's about 4% increase from last quarter. That means its loan book is increasing. Finance cost would obviously increase since its loan book is increasing. And if I look at outstanding loans, where outstanding loans is the loans given to the state governments, the private entities, and the joint ventures, its loan book has increased. If I look at net interest margin, so net interest margin is basically the difference between the rate of interest at which they borrowed to the rate of interest at which they lent out. So this is the profit the company earns in this case. And I would say the net interest margin has fallen by 3 basis point or 0.03%. However, if I look at the profit has jumped threefold from 435 crores to about 1840 crores. This is because the company had an exceptional item in the last quarter which has disrupted its net profit, and that's why its net profit is as low as 435 crores. Now, looking at year-on-year results, and this is where we see the growth of the company. The interest income on loan assets have increased by 15%. That shows really good growth from about 7,000 crores to 8,000 crores. Finance costs have also increased by 14% because, well, its loan book has increased. Outstanding loans, or the loans given to the state governments, private entities, or joint ventures, it has increased by about 18% from the loan book size of 2 lakh 81 crores last year to about 3 lakh 30,000 crores this year. And this shows the magnitude of this company. Looking at its interest income on loan assets, looking at the size of its outstanding loans, you realize that this company is not a small company, and this company has got good potential, and it's not this company is not joking around basically. If I look at net interest margin, the net interest margin has increased by about 4 basis points or 0.04%. However, if I look at the net profit has increased from 1500 crores last year to about 1839 crores this year, about a 23% jump. Now, let us have a look at its loan book. So, the loan book of this company is majorly dominated by the state governments. State governments, as of now, have loans worth 2,71,000 crores, and this means that state governments are more likely to pay than private entities, and it means that the loan book is really secure from any disruptions in the future, and it is secure from assets that would end up as NPAs or non-performing assets in the future. Uh, private Private entities compose of 11% of its loan book, state governments 82% of its loan book, and joint ventures at about 7% of the loan book. If I look at the distribution in the sense to what segments the loans are given out to, about 43% of these total loans are given out for the purpose of generating electricity. About 5% of the loans of about 3,30,000 crores are given out to generate renewable energy, 18% for transmission of electricity, and 34% for distribution of electricity, and 0%, this is actually 0.1%, STL stands for short term loans. So short term loans are also given to governments and private entities, so that they can run their day to day operations when they don't have enough cash available with them. Now, if I look at the top 10 borrowers of this company, the top 10 borrowers are Maharashtra State Electricity Distribution, Tamil Nadu Generation and Distribution, Maharashtra State Power Generation, Rajasthan, Telangana, Tamil Nadu, Andhra Pradesh, Nabinagar, Uttar Pradesh. So, if I look at the top 10 borrowers that have about 40% of the loan assets, it shows that all top 10 borrowers are state governments, and like I said, state governments are less likely to default than private entities. Now, if I look at its domestic ratings and international ratings, it has been given AAA rating by CRISIL, ICRA, CARE, India Research, and Ratings. However, if I look at international ratings are, you know, more scrutinized. International rating agencies would rate a company on the basis of its peer comparison to other companies in the world. So Fitch and Moody feels that though REC is a big company, it doesn't deserve as high as ratings as Crystal, ICRA, or Care Ratings has given. However, this triple B minus or Baa3 is a really good rating if I consider the ratings of Indian companies. However, they are not the best in the world if I talk about in the world. However, if I consider India, these ratings are really good. Now, top 10 shareholders of this company. So, this company is actually owned by the government of India through Power Finance Corporation, and Power Finance Corporation is another Navratna of this company. It is also listed in the stock exchange, just in case if you want to consider investing in this company. 52% by HDFC Finance Corporation, 8.6% by HDFC Trustee, LIC has 2.78%, Abu Dhabi Investment Authority has about 1.23%, and Prudential Assurance Company, HDFC Life Insurance Company, Vanguard Total International Stock Index Fund. So it has really good shareholders who have deep pockets. Now, if I look at the dividend yield of this company, this company has an excellent track record of paying dividends, and trust me when I tell you, this company provides a dividend yield of as high as about, as I would say, 10.4%. It has a dividend yield of 10.4%, and very less companies that are really good and are as big as REC give the dividend yield of 10.4%. So it is something to consider at this market price. So it has been giving 110% dividend at the face value of 10. So it is giving you about 11 rupees dividend per share. Now let us have a look at its share price. Before going to its share price, its market capitalization is about 20,900 crores, and its price to book value is 0.60. That means it is trading below its book value, and it shows that this company is undervalued as of now. Now, looking at the share price, REC right now is trading at 105 rupees, and as I discussed, its dividend yield was about 10.4%. It has paid 11 rupees dividend on a share of face value of 10. If I divide 11 rupees by 105 rupees, it gives almost a 10% dividend yield. Now let us have a look at its chart. If I look at this year, it made a high of 155 rupees, and as of now it is trading at 105 rupees. So if I look at the year discount that you have is 50 rupees, and it's a pretty good discount. If I look at 2 year period, it made a high of 167 168 rupees. 5 year period, it made a high of about 218 rupees. And look at the dividend, look at the track record of dividend in the last 5 years. It has given dividend at least, I would say, 9 times, and it has given bonus once. So even if this stock stays flat, the dividend yield would more than compensate its returns that it may or may not provide. So guys, this is my take on REC, and this is an excellent company, and it's a really good company for a short-term investment. And by short-term investment, I mean 3 to 5 years. Its dividend is really good. You can sell it for maybe 150 rupees in the next 3 years, a 50% profit, and the dividend that you get is a surplus for you. It's like a cherry on the top. So guys, this is it, and I hope you liked my video. Thank you very much.